Before we get on with today's podcast, here's a special announcement for our podcast listeners. From time to time, you hear Steve Peasley talking about portfolio checkups in locations in the San Francisco Bay Area, Los Angeles, and Orange County, and that kind of leaves you out if you live in Orange County, Florida. Well, don't feel left out. If you would like to take Steve up on his offer to look over your portfolio and give you a health scan, it can be done on the phone. You can send copies of your documents by fax, email, or regular mail and join Steve for a one-on-one conference call. If you're interested, just go to investtalk.com or call our 24-hour InvestTalk answer line at 888-99-CHART. That's 888-992-4278. And thanks for listening to Invest Talk. Welcome to our 1-hour meeting of the minds about money, your money. This is Invest Talk, made possible today and every day by KPP Financial. It's about managing risk while looking for profits, putting the money you worked for to work for you. And now, here's registered investment advisor Steve Peasley.
Good afternoon, everybody, and welcome to Invest Talk. And, of course, it's the Friday edition, December 19th. Welcome to we're really glad to have you, and I say we are glad to have you because today I have with me Helen Crawford, who is another registered investment advisor at KPP Financial. Helen, thanks for coming.
Hi, Steve. It's good to be here.
Now, we want to thank you again for making this show, Invest Talk, part of your day. We always say if you invest some time before you invest money, you'll be a lot better off. You need to guard against overestimating your knowledge and competence. We try to. We don't think we know everything. Matter of fact, we know we don't know everything. The more you learn, the more you understand how much you don't know. That's a key. So you need to educate yourself, and you need to constantly do it. You need to prepare yourself to make good, sound decisions. You can do it, but it does take a commitment of some time and some effort on your part, okay? Now, we'll try to use your time wisely today. We count on you to keep us on track. That is talking about things you want to know about, not necessarily what I want to tell you or Helen wants to tell you, but what do you want to talk about? Our anytime answer in line is open 24 hours a day. You can call and ask a question, and you know that's 888-99-CHART. But also on the program, you can send us an email live, 888-99-CHART@gmail.com. So if you have a question, you're sitting at a computer, you can submit a question while we're on the air, 888-99-CHART@gmail.com. Now today our talking point is making smart decisions on mortgage repayments. That's what our talking point's about. Think about it. Now with interest rates approaching 5%, we're going to have a huge rash of refinancing. I have a feeling it may drop even below 5% and not too different. Remember, the Fed funds rate is 0. So if banks are charging you 5% on a mortgage, they're making 5%. That's a huge spread. Normal spreads are 2.5%, 3.5% between the Fed fund rate and the mortgage rate. So I can see that our mortgage rates could drop once the banks start to feel a little bit more comfortable with making loans. Right now they don't. And I do think the refinancing may start that cycle of comfort. I'm hoping so anyways, so that the banks will get a little bit more free with their lending. Now, I'm not saying loosening up standards. I don't think they ever should have done that in the first place. I'm not talking about that. I'm talking about having the courage to make normal loans to quality lenders. Which, remember, 95% of all mortgages out there are paid on time every month.
And Steve, with these mortgage rates going down, the next question will be, should you pay your mortgage off early?
Well,
quickly.
I always think you should. I always suggest to people pay extra every month.
Even with the low interest rate?
Even with the low interest rate. Now, people are going to say, well, wait a minute, what if I can make more money on my money over here investing it as opposed to over here paying it toward my mortgage? Mm-hmm. Well, my retort to that has always been, your house It has no risk. If you pay off your mortgage, it's like and it's a 5% mortgage or a 6%, it's like you're earning 5 or 6% on the money. Okay, because you don't have it to pay it anymore.
And for me, Steve, it's also would have to come down to a comfort level. I know when my parents are really old, and I can remember as a child, they used to say, pay off your house, nobody can take it away from you.
Once you pay it off.
Uh-huh.
Well, except for the government, because if you don't pay property taxes.
Well, yeah, of course.
But yeah, I think that once you retire, you really want to live in, comfort. That means no mortgage. You don't have to have that payment. You don't want that payment when you retire. Anyway, so that's going to be our talking point. It's an article on Yahoo Finance, the mortgage professor Jack Gutentag. He says, we can't undo the past, but we can make better decisions in the future. So he's offering this guide on how to make decisions about mortgage repayment. It's an article. It's on our website, investtalk.com. You can take a look at it. But first, let's talk about what happened in the market today, stock market. Actually, it started up on an up note and rallied a little bit up above 100 points on the Dow. The Nasdaq and S&P did better than the Dow today. The Dow actually got up, about 150 points on the upside before it started to fall. And it fell pretty much during the day after the good news from the big three, with Bush announcing his bailout for them. Well, or partial bailout. I don't know what you want to call it. It's $17 billion. A billion here, a billion there.
A small piece in the big scheme of things.
Yeah, it's just a little bit of money.
Mm-hmm.
I wish I could have $1 billion. That would be nice. Well, you know what I would do? I'd probably give away most of it. I don't have a need for that kind of money. I'll give you a couple dollars, too. How about that?
And I'd pay off my mortgage.
But that's what happened in the market. It ended up on the upside for the S&P 500 and the NASDAQ, but on the downside for the Dow. The Dow actually had a much weaker 5-day period this week than the NASDAQ and the S&P. They looked better this week than the Dow. So the big Dow stocks, why? Well, first of all, you got a couple of auto companies in there. You got, some issues, banks still having problems. The Dow is full of big stocks, but some of these big stocks are having problems. So it's not always good news on those big stocks. Okay, so now it's time for you to get involved. Make your phone call if you would. Ask your questions. We have opened the lines for your question and answers, and even your comments, whatever you want to talk about. The number is 888-99-CHART, 888-992-4278.
This message is for our AM 1550 listeners. Starting January 1st, Invest Talk will be moving to our new address, AM 860. That's AM 860, starting January 1st.
Okay, let's go to Fred in Stanford. How you doing, Fred?
I can feel it in my bones. I can feel it everywhere. We're going to have a marvelous bubble burst of the bond market.
Oh, I think you're right, Fred.
And the question I'm going to ask you, we're going to go over some details here. When this occurs, lots of other repercussions will come. But let's first look at indicators, precursors to the bursting of the bond market. Would we best look at short-term bonds, mid-term, or long-term bonds?
Well, you mean as far as looking for an indicator?
Yeah, sure.
I think you need to look at the